Welcome to Talk Tickers. Today we're diving deep into the first quarter 2025 earnings call for Eastman Chemical Company.
Yep, pulling out those key insights for experienced investors like you.
Exactly. We'll hit the headline numbers first, then unpack what management's thinking about the current challenges in the future.
And then stick around for our not financial advice segment. We've got a trade idea sparked by all this.
All right, let's jump in. Q1 results. What's the snapshot?
Well, it was a bit of a mixed bag, really. Operationally, they did quite well, especially with their methanolysis program down in Kingsport.
That's the chemical recycling tech, right?
That's the one. They hit high production rates, 85% yield on the DMT feedstock. Pretty impressive.
And that flowed through to the bottom line.
It did. Added about $25 million in earnings under corporate other, mostly because they didn't have those initial startup costs hitting this quarter.
Okay.
And they're also on track for the $50 million EBITDA target from cost improvements in the Renew program overall.
So Renew operations sounds solid. But I heard the revenue outlook wasn't quite as rosy.
Yeah, that's the other side of the coin. They revised the Renew revenue guidance down. Used to be $75 to $100 million. Now it's $50 to $75 million.
Ouch. What's driving that?
It seems to be squarely down to the trade tensions, particularly U.S.-China tariffs and the expected impact on the consumer durables market.
Right. Things made in China using their material.
Exactly. It's hitting product launches.
Yeah.
The fibers business is also feeling it. Customer destocking is a big factor there, plus those tariffs on exports to China.
So with all that uncertainty, did they adjust their annual guidance?
They did. They actually withdrew the annual earnings guidance.
Okay.
But interestingly, they kept the annual cash flow guidance in place, really emphasizing cash generation.
Yeah.
They're trying to show stability amidst the uncertainty.
Makes sense. Focus on what you can control. What about Q2?
They gave EPS guidance for the second quarter, $1.07 to $1.90.
That's a pretty wide range.
It is. And they basically said that width is mostly down to demand uncertainty, especially heading into June.
Okay, so let's dig into that Renew program a bit more. Operations good, costs improving, but the revenue forecast cut, you said purely tariffs.
Yeah, management was quite clear. The reduction is solely pinned on that expected slowdown in consumer durables made in China because of potential tariffs. It's delaying new product rollouts that use Renew.
But customers aren't abandoning it.
No, apparently engagement is still strong. Very few actually switched back to standard Triton, which is positive.
And what about other applications?
Well, food packaging engagement using their ARPIT product, that looks quite good. Brands are interested because, frankly, mechanical recycling has its limits, and Eastman's offering an alternative.
Okay. And then fibers, you mentioned destocking and tariffs there too.
Right. The market itself is growing slowly, maybe 1-2%. But the real volume hit is customers just working through existing inventory. Yeah, and it's lasting longer than they thought. Probably because there's some looser capacity in China now, maybe 5% of the ex-China market size.
Are their contracts holding up price-wise?
Pricing seems stable. They've got about 90% of this year's contracts locked in, and even 80% for next year.
But volumes are the issue.
Exactly. Those contracts have volume bands, and customers are, buying at the lower end right now. Plus, you've got some discontinued product lines from customers and energy headwinds adding to the pressure.
And the direct tariff hit on fibers.
It's hitting NIA textile fibers. About half their sales there are in China, though they're trying to diversify. And then there's cellulose flake for the Chinese National Tobacco Company that's facing pretty significant tariff rates.
Price-sensitive market, I imagine.
Very. So that impacts volume directly.
So navigating this trade environment sounds complex. Withdrawing the annual EPS guidance really highlights that uncertainty.
It absolutely does. It's a direct signal about how unpredictable things feel right now, especially with the trade disputes.
But holding the cash flow guidance.
Yeah, that signals confidence in their levers there. Managing working capital, finding operational efficiencies, controlling resources. They feel they have a tighter grip on the cash outcomes.
Right. Provide some kind of anchor. Let's break down the China sales and tariff picture more broadly. About 60% of their China sales originate in the U.S., you said.
Correct. And the impact varies quite a bit by segment.
Okay.
Coatings Intermediates, or CI, has very little direct exposure. Might even benefit if tariffs hit imports coming into China.
Interesting. What about additives and functional products, AFP?
Limited direct exposure there too, maybe $200 million revenue in China last year. They have production flexibility, Europe and China, but they are seeing some short-term headwinds in Q2. Customers delaying orders for especially cellulose additives, likely due to the uncertainty.
Okay, and the big one, advanced materials, AM.
Yeah, largest segment in China. And it's a mixed picture, interlayers. 8 in China, no real tariff issue there. Performance films. They're actively ramping up production in China and Germany to rely less on U.S. exports. So maybe some inventory stuff in Q2, potentially a headwind later if things don't resolve.
And specialty plastics, like Triton.
That's where there's significant uncertainty. A lot of that material made in the U.S., sold to China, is then re-exported in finished goods to the U.S. and Europe.
So if those finished goods get hit with tariffs.
Exactly. Big potential back half exposure if tariffs stick and supply chains have to shift. They estimated the Q2 tariff impact across the board at around $30 million.
And that's mostly a volume hit, people hesitating.
Primarily volume, yeah. Customer caution.
And all this uncertainty seems to be feeding into their CapEx plans too, right?
Yeah.
Specifically the Longview project in Texas.
Yeah, that was notable. They're actually reducing the expected spend on Longview. The midpoints come down from roughly $750 million to about $550 million.
How are they doing that without delaying it?
Optimizing engineering, delaying some commitments strategically. They were clear this is about preparing for potential downsides from the trade disputes. Basically, being cautious.
But regular maintenance spending is still happening.
Oh, yeah. Maintenance CapEx is still around $350 million, which is, still above DNA. So they're keeping the existing plants running well.
And the DOE funding for Longview? Still confident?
Seems so. They feel it aligns well with the administration's priorities, U.S. manufacturing, circular economy, energy independence, all that.
Have they received funds?
Yeah, Q4 last year and Q1 this year. There's maybe a slight slowdown finalizing the next phases, some DOE staffing changes mentioned, but they don't see it as a risk to the project funding itself.
Okay, so cautious CapEx, but core projects still moving. What about the general consumer? Are they seeing demand weakness beyond just the direct tariff effects?
It sounds like it. The Q2 guidance reflects not just that $30 million tariff hit, but also just weaker seasonal growth than usual. General consumer caution, it seems, tied to economic uncertainty and the tariffs. Might even be pulling some demand forward from the second half, which isn't ideal. Customers are definitely being more careful with inventory builds.
How did April look?
April orders were similar to March, which is, I guess, okay, not falling further, but June is the big question mark.
Which brings us back to that wide Q2 guidance range, $1.07 to $1.90. And you said the main driver is June demand.
That's the primary factor, yes. How customer demand holds up in June, heavily influenced by where these trade talks are or aren't going.
Any other factors in that range?
Minor things, maybe natural gas prices, currency fluctuations, but really it's about June volume.
Got it. And circling back quickly to fibers, you mentioned contracts are in place, but customers are buying at the low end. So that destocking is just broader than expected.
Seems that way. It's not just one or two customers. A wider set are just being cautious and buying minimums right now. Leads to a bigger destocking impact than they first thought.
Any hope for improvement later in the year?
They do expect a modest pickup in the back half, assuming these inventory issues start to resolve.
Okay, it sounds mostly like headwinds from tariffs, but are there any, potential upsides or silver linings for Eastman in this situation?
That's a good question. Yeah, they did point to a few potential opportunities.
Like what?
Well, performance films in North America. Their U.S. manufacturing scale could actually become an advantage against imports hit by tariffs.
Okay.
Specialty plastics. Similar idea, potential for more demand for U.S.-made substitutes if imports get pricey. Their ag business might see some relief for customers who are facing dumped imports.
Right.
And even building construction potential for some reshoring of things like floor tile production back to the U.S. Plus, coatings intermediates might see better pricing over time as things settle.
So some potential offsets. How are they thinking about a broader recession? They mentioned a manufacturing recession that's kind of been ongoing.
Right, since mid-2022, they figure. But they noted current inventory levels aren't super high across the economy.
Meaning another demand drop might not be as sharp.
Potentially less severe than the 22-23 drop, yeah. And price cost dynamics might offer some offset, too. They listed a whole range of mitigating actions they're taking.
The cash-focused tariffs.
Exactly. Cash focus, tariff strategies, innovation push, commercial efforts, the methanolysis contribution, managing CapEx carefully. They cautioned against just using 22-23 as a direct proxy for what might happen now.
And if tariffs did get resolved, what's the upside?
They suggested AFP and AM could potentially see low to mid-single-digit volume growth in the second half, partly helped by restocking then.
Okay. One last detail, the plant turnarounds. $20 million headwind.
Yep, mostly hitting in the first half. Q2 and Q3 expected to be similar turnaround impact levels.
And then improving in Q4.
Should improve in Q4, yeah. They said front-loading it helps with managing inventory and cash flow right now, given all the uncertainty.
All right, makes sense. Let's shift gears then to our signature "This is not financial advice" segment. Based on this Eastman call, all the talk about tariffs, supply chains, what's an outrageous but plausible trade idea you've been kicking around?
Okay, here's a thought experiment for you, playing on that whole reshoring theme that keeps bubbling up. What about a long position in North American companies focused on manufacturing capital goods? The machinery, the equipment needed to build or expand factories here.
Okay. Going long the factory builders.
Sort of. Coupled with maybe a short position in companies that rely heavily on importing finished consumer goods into the U.S., specifically from China.
Right, so bet on reshoring actually happening.
That's the core idea. If tariffs stick around or even escalate, building stuff locally looks better. That means demand for the machines to do the building goes up.
And the importers of finished goods get squeezed.
Potentially, yeah. Higher costs, maybe lower volumes, squeezed margins. It's a directional bet, really, on trade policies significantly reshaping North American manufacturing investment.
Interesting. Betting on the picks and shovels of reshoring, essentially.
You could put it that way. But remember, folks, this is strictly a hypothetical for discussion, not investment advice in any way, shape, or form. Do your own deep dive, your own research before ever making a trade.
Absolutely. Always do your homework.
So that really wraps up our look at Eastman Chemical's Q1 call. We've seen strong operational execution, especially in new tech.
Yeah, but really grappling with these significant headwinds from trade policy uncertainty, a real focus on managing cash through the storm.
It's fascinating, isn't it, how one big macro factor like trade can just ripple through every part of a global company like this.
Absolutely. From revenue to CapEx to strategy, it touches everything.
So for you listening, how do you see these trade dynamics playing out? Will we see more reshoring? How might this reshape chemicals and manufacturing long term? Lots to ponder there.
Definitely keep doing your research.
And join us next time on Talk Tickers for another deep dive into the forces moving the markets. Remember, it's perspective, not financial advice.